This year, a variety of bullish and negative reasons have competed for control of the oil market as efforts by OPEC Plus to tighten the market have clashed with worries about the expansion of the world economy. Prior to the additional Saudi production cuts on top of the OPEC Plus reductions in July and August, prices were mostly fluctuating between $70 and $80 per barrel for the majority of the first half of this year. This week, prices reached a year 2023 peak of over $90 per barrel after Saudi Arabia and Russia each extended their respective supply cuts through the end of the year. However, despite ongoing worries about the expansion of the world's two largest economies, the United States and China, as well as Europe's already sluggish, barely their growth, oil prices have not increased significantly. According to Reuters columnist Clyde Russell, uncertainty is still present and is keeping oil prices in a small range, which ironically results in relatively steady oil prices. It's true that the most recent news of the supply cuts extensions raised the price of oil. However, they only increased to a trading range of $85 to $90 per barrel, and analysts are not rushing to forecast $100 oil in the near future. This is due to the growing uncertainties surrounding the global economy and the rise in oil demand. As the main producers of sour crude in the Middle East hold back certain shipments, the OPEC Plus production cutbacks have tightened the market, particularly the market for sour crude. For instance, it is predicted that Saudi Arabia's crude oil exports in August fell to their lowest level since March 2021 as the country continues to reduce output by 1 million barrels per day, BPD, in order to maintain tight markets and raise oil prices. The market is tight, and the most recent cuts that have been planned through the end of the year are expected to widen the gap in the fourth quarter, analysts believe, helping to strengthen oil prices. According to a note published on Wednesday by Ole Hansen, head of commodity strategy at Saxo Bank, tight market conditions are still on clear display through the elevated backwardation shown across the forward price curve, not least at the very front where prompt spreads in WTI and Brent both command a backwardation around 65 cents per barrel, up from close to flat around the time Saudi production cuts were implemented. There is no doubt that the current production cuts will keep the oil market tight, supporting oil prices, even though the upside, in our opinion, remains limited. However, whether that support translates to stable or higher prices will depend on incoming macroeconomic data and, with it, the outlook for demand, Hansen added. According to ING strategists Warren Patterson and Eva Manthe, the most recent cuts leave the market with a larger than anticipated deficit in the fourth quarter of 2023, which could support prices going forward. The bank is hesitant to raise our price projections as a result of this prolongation, though, as demand worries persist and Iranian supply is increasing. A modest surplus is projected for the first quarter of 2024 in ING's oil balance prediction, which should prevent prices from rising dramatically. The bank is still predicting that the price of Brent crude would average $92 a barrel for the final 3 months of this year. Given that our balance sheet indicates that the oil market will be in a slight surplus over the first quarter of next year, we would not rule out extending these cuts further, totally or partially, until the beginning of the next year. Any reductions will, of course, depend on the price of oil near the end of the year and whether concerns about demand are still prevalent, according to ING strategists. Since early this year, when Chinese macroeconomic statistics showed a less than spectacular comeback after the reopening, macroeconomic headwinds and demand concerns, particularly in China, have been persistent. Concerns over whether the Fed will manage a soft landing after more than a year and a half of interest rate hikes were also exacerbated by increasing interest rates in the U.S. Recent reports indicate that the labor market is slowing, and the Fed may decide to stop raising interest rates when it meets at the end of this month. However, if the increase in oil prices fuels inflation once again, interest rates may be held higher for longer, which would slow down both economic growth and oil demand. According to Hansen of Saxo Bank, China's demand for crude oil is now high due to stock buildup and demand from refineries, who are exporting more gasoline due to weak domestic demand. The slowing economies in China, Europe, and possibly the US combined with rising oil costs does not in our opinion support sharply higher prices, he continued. We do not support the $100 per barrel camp, but we do not rule out the possibility of Brent trading above $90 for a brief window of time. In an effort to boost oil prices, Saudi Arabia and Russia extended their respective continuing production and export restrictions to the end of the year. As a first reaction to the announcement on Tuesday, Brent crude prices surged beyond the $90 per barrel threshold, reaching the highest level this year. The extension of Saudi Arabia's 1 million BPD cut through December strengthens the precautionary efforts made by OPEC Plus countries with a view to supporting the stability and balance of oil markets, the kingdom claims. The Saudis will pump 9 million BPD until the end of the year due to the cuts, which will be reviewed each month to determine whether to further reduce the reduction or increase output based on the situation of the market. Additionally, Russia continued its 300,000 BPD export cut into December with the ability to evaluate each month and may further reduce exports or boost supply, depending on the state of the market. For their budgets, Saudi Arabia and Russia both depend on high oil prices, but their support for the stability and balance of the oil markets may undo some of the work the Fed and other central banks have done over the previous 15 months to contain inflation. At a time when Wall Street has increased the likelihood that the Fed would pause the interest rate hikes at their meeting at the end of October, higher oil and energy costs might ignite inflation once more. The U.S. jobs data released last week indicated a slowdown of the labor market. Analysts claimed that this was the information the street needed to price in a halt to rate increases this month. The rate of unemployment rose from 3.5% to 3.8% as wage gains stalled. According to Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance, the Fed couldn't hope for a better report in their fight against inflation, according to a statement published by Business Insider. The Fed can afford to leave rates where they are and patiently wait for higher rates to do their job if the economy can continue to grow and the labor market can cool off gradually rather than quickly, Zaccarelli continued. After all the rate increases since February 2022, a gentle landing for the U.S. economy might relaunch the business cycle and boost inflation. However, oil at $90 a barrel and above, thanks to Saudi Arabia and Russia, would only increase inflationary pressures, potentially erasing some of the central bank's efforts to contain the runaway consumer price increases of the previous 2 years. Saudi Arabia extends its 1 million BPD output cut through the end of the year because it is concerned about the demand picture. Ole Hansen, head of commodity strategy at Saxo Bank, commented on the prolonged production cuts, calling them a move that will boost demand. Worries a sticky energy-supported inflation may force central banks to keep rates higher for longer, thereby raising growth and demand concerns. Ed Moya, a senior market analyst at Oanda, claims that it appears that Saudi Arabia and Russia are in agreement about maintaining a competitive oil market. After Saudi Arabia and Russia announced the prolongation of their oil supply restrictions, Moya wrote in a note that OPEC Plus appears to be committed to keeping the oil market tight no matter the cost to the global economy. The expert noted that there are high expectations on the markets for the U.S. economy to have a strong third quarter and a respectable fourth quarter, with recession concerns likely delaying until next year. Oil prices are held at roughly $90 per barrel because to rising oil output from non-OPEC Plus producers, which partially offsets the extended cuts, according to Moya. However, we might easily see $100 oil if any supply disruptions materialize or if winter weather predictions become more likely. If economies can avoid going into serious recessions, oil prices above $90 and possibly $100 are a prescription for a new surge in inflation. What are your thoughts on Saudi Arabia and OPEC Plus? And do you think they can overthrow the U.S. economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching and I'll see you in the next one.